Welcome back then, and hopefully now you've uploaded your activity. In that session, we sort of outlined the project life cycle. We talked about initiation, planning, execute, monitor and control, close and evaluate, and we examined the roles and responsibilities from the owner through to the team. The initiation and planning stage, probably most important of all, and it's where the owner, the sponsor, the project manager, whoever within your organisation you decide, work together as part of that project board or that steering committee. And as we said, it'll be different in every situation, so it'll be dependent on your project, your situation, your organisational structure, and the process your organisation follows. But in the next session, we're going to look at some general principles of setting up that project, initiating it, and planning the project so that you can follow those, or where there is things in place, you can evaluate what your standard practices are within your organisation and see if you think you're hitting all the points. So let's have a look at the aims. So overall aim is to know how to set up a project. By the end of the session, you should be able to explain how to carry out a cost-benefit analysis for a project, and we'll look at that in a second. Describe the considerations when setting and agreeing a project budget, and we'll start looking at that. In the other parts, we'll then move on to evaluate a project planning tools and techniques, evaluate the use of risk analysis tools and techniques, and we'll be looking at a number of tools for planning the project and a number for risk analysis. And then we'll talk about describe how the documentation used to set up and manage a project, and describe a range of different project management tools. We'll do that at the end before we get to the sort of next session. Right, let's get started. So what's cost-benefit analysis? Well, simplistically, and in project management terms, it's about deciding quantitatively whether to go ahead or not. So you see, it's about balancing the costs against the benefits, and usually in monetary terms. They're often quoted sort of a rule of thumb that the overall cost should be less than 50% of the benefits. And additionally, the payback period, and we'll talk about that in a minute, shouldn't exceed a year. So that's the length of time it takes to recover the costs. The shorter the better, obviously, so the initial outlay is at risk for a shorter period of time. But as I just said, that's a rule of thumb, and in project management decisions, there's a lot of other things that need to be taken into account, and some bigger projects are just not going to be paid back within a year, and we'll look at some calculations for that later on. But it's about deciding whether the project can go ahead. It could also be used to compare projects or compare plans for a project against each other to see basically whether it's worth the cost and the effort to see which one is the one we should go ahead with. So that's what cost-benefit analysis is, but how do we go about it? It's a simple process really, although actually doing it is not quite as easy. Step one, we obtain the complete cost estimates, so that's direct and indirect costs. Step two, we obtain the complete benefit estimates, so that's tangible and intangible benefits. We'll talk about those in a bit more in a minute. And then three, we choose an appropriate cost-benefit analysis algorithm to calculate, analyze the cost and benefit streams. So some algorithm are going to be talking about calculating depreciation or capital values, and it's going to depend on what your project is about, what your organization does. Step four, we compute estimated costs and benefits schedule over a period of determined payback time, and we'll talk about how we calculate that in a minute. And then we calculate the payback value of the project and make our recommendations. So straightforward process really, but not as simple as it is, and we'll look at some of the detail. So one of the key areas for this cost-benefit analysis is that step two, obtain complete benefit estimates, because we need them in monetary terms, because we're talking about quantitative, not qualitative data here. Tangible things like reduced or increased operating costs, which we could say was a benefit, are going to be easy, and slightly harder the predictive things like improved staff retention or increased revenue, because we can calculate those. But the harder ones are going to be the intangibles, such as improved staff morale, for example, better working conditions, an improved reputation of the company. They are really qualitative measures, but where possible, well, we have to express them as a benefit in cost of a monetary term. So we're going to need to calculate them, because we need to compare them with the costs that we've got for putting the project, for initiating it and putting the project on, I suppose you could say. So improve staff morale, better working conditions, those sort of things, we're going to have to look at those and examine things, for example, like reduced sickness in absenteeism, which we can put a cost on, less grievances and complaints, which we can put a cost on dealing with a grievance or a complaint. And costing those things can help us think about, costing how much it might be to replace those people if we had that sickness level, and then we'd reduce it so we can see a benefit in pounds, shillings and pence there, showing the age there. But we need to predict it, and we need to predict that saving, and we're going to have to use subject matter experts to get advice there. While we're assessing, considering all these costs and benefits, there's some other factors that we're going to have to consider. And one is the potential cost of not doing anything, so not doing the project at all. It may not be the most beneficial money-wise, but would we lose out by not doing it? Are we going to be left behind? We also need to consider the potential cost if the project fails. Where's it going to leave us? So potentially we're not committing so much that if it fails, we're left with nothing. And the final one we need to consider is the opportunity cost. So in other words, the potential benefit that we could realise if we spent our time, our money, our resources in other areas on a different project or on something else. What opportunity are we missing if we're committing everything to this project? So these are other considerations we've got to add on top of our cost-benefit analysis. And whilst we've been examining cost-benefit analysis there, we've used the term payback period, and it's vital in doing a CBA. We need to calculate that payback period, and there are a number of formulas, but there are two sort of clear ideas, and we need to select whether we're going to be looking at an even cash flow return or an uneven cash flow. So are we going to get things back evenly over a period of time, each period the same amount, or is it going to be uneven and it's going to vary as it goes through? And depending on that, we've got two different formulas we can pick. So if the payback is even, that's going to be that we're getting a set amount each period, then it's quite a straightforward calculation, and that's the payback period is equal to the investment divided by the cash flow each period. So the example is a company that's investing 100k in a project and they're getting 110k back per year, probably over the next 3 years. Then we're saying 100k divided by 110k gets us 0.9, so that's less than a year, which fits in with our rule of thumb that we were talking about. Whereas when the cash flow return is uneven, we're going to need to calculate a net sort of cash flow figure for each period and then use that in a different formula. So for example, a company is planning a project with an initial investment of 50k, and then they're going to continue to have to give decreasing amounts to keep that project going, but they only expect it to generate 10k in the first year and then increasing amounts as it goes through the following years. It might look like this. The table shows their calculations for their costings, and you can see the year, then the cash flow, first figure being what they've had to put in, and then the second figure what they've generated, and then a total, and then a cumulative cash flow at the end. And the calculation for this would be payback period equals A plus B divided by C. So that would work out in that A equals the last period that there was a negative cumulative cash flow, which is going to be 3. B is the value of the cumulative cash flow at the end of that period. So period 3, the end of it was 18. And then C is the cash flow during the period after A. So as we can indicate there, 19. So we'd end up with a calculation of 3 plus 0.95 equals a payback period of 3.95 years. So a much longer project predicted return there, and we'd have to use that calculation if we're seeing an uneven cash flow return. So that's really cost benefit analysis in a nutshell, but there's some principles that we need to consider as we're going through that process. And the first is we must use a common unit of measure. So in the case we were talking, it was all in pounds. We talked about how that we have to try and turn those qualitative things into some sort of cost measure. And we need some transparency. It increases the engagement and the involvement of people, and that therefore going to add to the value and the credibility of it. And there's no point otherwise. We need to identify and clearly show that with that transparency any areas of uncertainty, and then outline the approach we've used to overcome those. And we've got to make sure that overall the efforts of doing the CBA do not overshadow the expected value. So we're not spending so much time and effort on doing the cost benefit analysis that actually it's become a negative. And then we don't want to exaggerate any potential funding streams because it's just going to skew it and put it off. So doing that CBA is going to be part of preparing and agreeing the project budget. It's integral to it. It's part of the business case for the project. It's a sort of an evaluation of the financial requirements and central to establishing whether the project is viable or not. Initially, we're going to be working on estimates, aren't we? And then along with the CBA, and as we refine the feasibility and the desirability and the initiatives are investigated fully and we understand the scope, as it all comes together, basically, I suppose, and we're scheduling and talking about resources, we'll come up with a budget, and then we'll need to get that budget approved because it will identify the planned expenditure for the project, and it's going to be the baseline which the project's expenditure and predicted and eventual costs are all going to be reported on and judged against, and they're going to be linked with the activities in the project schedule. So the project budget really important, and is all going to come together in three main components. And they're going to be the base cost estimate, contingency, and a management reserve. And the base cost estimate covers those known costs that we're talking about, such as resourcing, so staffing, hiring, subcontractor fees, any accommodation costs, rent, for example, any consumables, e.g. the power or the IT supplies that we're going to use during the project, the expenses, the travel and subsistence, and then any capital goods, so purchases of machinery, equipment, any new buildings, furniture, and fixtures and fittings. And these costs can then fall into a number of categories: direct, indirect, fixed or variable in the table there, direct being exclusive to the project, indirect being other sort of overheads that are shared out across other sort of things, so that'll be stuff that's already ongoing perhaps, fixed, which will remain regardless of the output achieved, so if I had to purchase something, if the project finishes early, you still have to pay out that cost, and then variable, such as people's salaries, things that would fluctuate depending on how long the project runs for. And then there's the contingency and the management reserve. So contingency will be money set aside for responding to identified risks, and we'll talk more about identifying those later. But basically, things that we've identified that could go wrong, and therefore we have to make sure we've got some money allocated to cover these eventualities. And then a management reserve, and this is open and vague, and it'll cover any factors that have not been foreseen. So we'll be discussing these more in session 3, but they're unanticipated risks or changes to the scope of the project, for instance. The higher the risk, the bigger the uncertainty, and perhaps the larger the amount that should be in reserve, but not often the case. And all these costs can be included and detailed in a cost breakdown structure of CBS, and that will show the detail of them, and that's going to depend on how complex the project is and how much the costs are involved. So that's the budget in a very simplistic view. And whilst developing that budget, there's going to be some other things the project manager is going to need to consider, which make it a little bit more detailed and complex. He needs to be aware of any existing resource acquisition policies, any guidelines or procedures. In other words, the way the business goes about these sort of things, because they're going to have to be taken into account when he puts his budget together. He needs to be aware of any preferences of the owner or the sponsor or the stakeholders about how they want to do things, because that might influence the acquisition or costing decisions. And then he needs to take account of any previous or similar projects that can be useful in sort of providing information on how budgets went previously, where things were done. There may be some leftover equipment, there could be some bits and pieces that could be utilised from the way that budget went that could influence the budgeting decisions. So all those sort of things got to be pulled together in putting the budget together before it gets approved. Once all that's all been sorted out, the budget's going to need to be reviewed and then agreed with the sponsor. But in doing that, there's going to be a number of factors to consider. Firstly, does it follow the accounting and reporting requirements set out by the owner and by the organisation you're working in? They'll have reporting formats to help aggregate the sort of accounts of the whole company, and they're going to be interested in tracking such things as assets, liabilities and income, and your budget needs to be flexible enough to fit in with that. And then, do you have agreed budget reporting requirements? So, you know, what's the owner's requirements, what's the project, and what's the organisation's requirements about when the budget needs reported. It could be about tax years, it could be about certain other reporting requirements, but you want to be able to fit in with those so that your project's financial information can aggregate into specific reports and things that they're preparing. And then what and how will it be done? So it's good practice with larger projects to have some sort of budget reporting plan outlining the requirements of the internal and external parts of the project and the dates and periods when things have to be calculated and returned. And then, do you need a budget management plan? So we're just talking about a document that describes how variances will be dealt with in the project, levels of authority for making changes to the budget, and a process for making changes to the budget. It doesn't have to be complicated, but it could be just simple one-page document that shows or relates to organisational policies perhaps that are already in place. Each project, each situation is going to be different, and organisations will have their own internal processes, so we need to consider that. And then before we seek approval, get it reviewed by the project team or other representatives or people from the finance department, because it's easier to do that at that stage. And then we seek approval from the project owner or sponsor, and approval may be a case of a bit of negotiation, a bit of to and fro, depending on the size of the budgets and what's available. But in the end, it needs to be signed off and agreed as part of the terms and conditions of the project. Right then, chance to round up. We've looked at cost benefit analysis and how to do them, what they're for. We've looked at budgets, project budgets, and the processes for agreeing them. We do a quick activity now, just to bring that together. Two-part activity. In the first part, around cost benefit analysis, I'm going to ask you to explain the steps involved in carrying out a cost benefit analysis for a project. So there's also a quick guide in the resources. You might want to research it further. And then part two, research the budget process requirements within your organisation, and then consider and research and describe the principal features of two factors that need to be considered. So 2 factors when setting a project budget and 2 factors when agreeing a project budget. Now, we've been through some, and then when you do some research within your own organisation, you may come up with some others, but you need 2 factors for each. So 2 factors, to principal factors to consider when setting a budget, and 2 when agreeing it. Great. Word document there, upload it when you're completed, and then move on to the next part.